Hello everyone, welcome to Business Education and Research. This video explains the factors that influence currency value fluctuations with practical examples. Currency values are influenced by complex interplay of economic, geopolitical and market-related factors. Let us explore each factors with examples. This slide shows how interest rates influences currency values. Monetary policy tool. Central banks use interest rates as primary tool to influence a nation's money supply, inflation and economic growth. Yield differential. When a country offers higher rate of interest compared to others, it creates an incentive for international investors to invest in assets denominated in the currency, leading to increased demand for the currency. Exchange rate impact. Higher interest rates can result in a stronger exchange rate for the currency, potentially affecting trade balances and making exports less competitive while attracting foreign investment. For example, if the US Federal Reserve raises interest rate, the US dollar tends to strengthen as it becomes more attractive to investors seeking higher returns. The economic indicators like economic barometer, currency strength, and inflation dynamics can influence currency values. Economic barometer. GDP growth, employment figures, inflation rates, and trade balances serve as crucial indicators for assessing a country's overall economic health and performance. Currency strength. Positive economic data such as robust GDP or low unemployment rates can bolster investor confidence, leading to increased demand for the currency and a potential increase in its value. Inflation dynamics. High inflation rates may erode a currency's purchasing power, causing it to depreciate, while low and stable inflation can support a stronger and more attractive currency. For example, if Japan's GDP growth exceeds expectations, the Japanese yen may appreciate. This slide shows how inflation influences currency values. Purchasing power stability. Currencies in countries with low inflation rates tend to maintain their purchasing power over time, making them attractive to domestic and international investors. Erosion of value. High inflation rates can diminish the real value of a currency, reducing its ability to buy goods and services, which in turn can lead to depreciation and decrease in its relative worth. Investment consideration. Investors often consider inflation rates when making investment decisions, favoring currencies from countries with lower inflation as a store of value and hedge against inflationary pressure. For instance, if the euro experiences low inflation compared to US, the euro may appreciate against the US dollar. Trade balance influences currency values in terms of trade balance impact, strengthening effect, and weakening effect. Let us see one by one. Trade balance impact. A country's trade balance reflecting the net result of its international trade activities plays a vital role in determining the demand and values of its currency. Strengthening effect. When a country consistently maintains a trade surplus, meaning it exports more than its import, it generally leads to an increase in demand for its currency, resulting in appreciation. Weakening effect. Conversely, a trade deficit where a country imports more than its exports can put downward pressure on the value of its currency as more of its currency is used to purchase foreign goods and services, reducing its relative worth. For example, if China exports more goods than it imports, the Chinese yen might appreciate. The geopolitical events influences currency values due to geopolitical uncertainty, conflict-driven fluctuations, and trade tensions. Let us see one by one. Geopolitical uncertainty. Political instability such as government changes or protest can create uncertainty in a country, leading to decreased confidence in its currency and potential depreciation. conflict-driven fluctuations. Ongoing conflicts or geopolitical tensions can lead to sudden and significant currency fluctuation with increased risk aversion causing investors to seek safe haven currencies. Trade tensions. Trade disputes and protectionist measures between countries can disrupt international trade, affecting a nation's trade balance and potentially weakening its currency due to reduced global export demand. For example, Brexit negotiation caused significant fluctuations in the value of the British pound. Market speculation influences currency values due to market sentiment influence, speculative trading, and feedback loop. Let us see one by one. Market sentiment influence. Traders' collective perceptions and sentiment play a crucial role in shaping short-term currency movements, often leading to rapid price fluctuations. Speculative trading. Traders often engage speculative activities, making bets on future currency movements based on their analysis of economic data, news, and other factors which can amplify short-term volatility. Feedback loop. Speculative trading and market sentiment can create a feedback loop where positive sentiment can lead to buying, driving up currency values, while negative sentiment can lead to selling, causing depreciation. This feedback loop can sometimes result in exaggerated price swings. For example, if traders believe a central bank will raise interest rate, they may buy that currency even before the actual rate hike occurs. Risk appetite influences currency values due to market sentiment swings, yield-seeking behavior, and safe haven demand. Let us see one by one. Market sentiment swings. Currency markets can experience shift in sentiment known as risk-on and risk-off periods, primarily driven by changes in market perception of economic and geopolitical stability. Yield-seeking behavior. In risk-on environments, investors often seek higher returns by investing in currencies of countries with higher interest rates and growth potential, potentially leading to the appreciation of those currencies. Safe haven demand. During risk-off periods, when uncertainty and fear prevail, investors tend to move their funds into safe haven currencies such as the Swiss franc and US dollar, which are seen as more stable and less risky to market turbulence, leading to their strengthening. Central bank policies influences currency values due to monetary policy impact, QE and currency depreciation, and tightening and currency appreciation measures. Let us see one by one. Monetary policy impact. Central bank can use tools like quantitative easing to inject liquidity into economy or tightening measures to control inflation, affecting the supply of nation's currency in circulation. QE and currency depreciation. When a central bank implements QE, it increases the money supply, potentially leading to currency depreciation due to oversupply, making the currency less valuable in international exchange. Tightening and currency appreciation. Conversely, central bank tightening measures, which involve rising interest rate and reducing the money supply, can lead to currency appreciation as it becomes scarcer and more attractive to investors seeking higher returns. For example, the European Central Bank's decision to expand its asset purchase program could weaken the euro. This slide shows how market intervention influences currency values. Currency stabilization. Central bank interventions aims to stabilize their currency's value, preventing excessive fluctuations that can disrupt their economy, trade, or financial markets. Exchange rate management. Interventions can be used to manage a country's exchange rate, making their exports more competitive by devaluing the currency or preventing excessive appreciation that might harm exports. Contingent measures. Central bank interventions can be a tool of last resort, often used when other policy options have been exhausted or in response to speculative attacks on the currency. where the central bank buys or sells its own currency to influence its value. For example, the Swiss National Bank intervened to weaken the Swiss franc during the European debt crisis. As concluding remarks, it is essential to note that these factors don't operate in isolation and their effects can vary in strength and duration. Currency values are also influenced by a wide range of other factors, and the forex market is highly dynamic and responds to news and events. Traders and investors often use a combination of fundamental and technical analysis to make informed decisions in the currency market.